The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. My name is Mike Barnes. You've probably seen the headlines. The Federal Reserve has cut the rates. 25 basis points. That's 0.25%. And we've talked about how that could affect gold, but what about silver? Let's ask the experts. Philip Diehl is here, and so is Brad Chastain. And Philip, I want to start with you as the 35th Director of the United States Mint and President of U.S. Money Reserve. You talked to MarketWatch, giving them an interview recently saying silver could be on center stage. How is this rate cut going to affect silver?
Well, it's already in the anticipation of the rate cut. We've seen a rapid rise in gold prices and silver prices. This has been a long time coming. We saw rate cuts, a series of rate cuts last fall, which ironically enough had the opposite effect of what we all hoped for, which is a lowering of longer term interest rates, which is what determines our rates on mortgages, car loans, and business loans. And so we've been waiting for a rate cut that would be about the right size in order to trigger lower interest rates for those of us who pay those higher long-term rates. And sure enough, as we approach this rate cut, the interest rates we pay fell, and we've all benefited from that. What we saw the Federal Reserve do yesterday was make a really modest move on interest rates, which is what the market expected. I think what the market believes is called for. There would have been possibly a negative reaction to a larger cut in which interest rates would bounce back up if, like they did last fall, if they were beyond the expectations of the marketplace.
Brad, as Director of Education at U.S. Money Reserve, you know firsthand that silver is having a great year.
Yeah, year to date, it's up more than gold. It's up 40+%, and it's been doing fantastic. And we talked a while ago about gold, if you remember. It was a few months back even, and this is something that we called attention to, that we expected is something that we'd see. So no surprises. A lot of people holding silver are happy to see it come, and it doesn't look like it's, for reasons we can get into, going to stop anytime soon based on some overall secular economic trends.
It may not be a surprise, but I think a lot of people are asking why. Why is silver outperforming stocks, bonds, and doing so well? Brad, what do you think?
I think it's a timing thing. You can't ever predict exactly when something is going to happen, but anytime anybody is looking to deploy money somewhere, you look at the available investment universe, if you will, and see where is the best place to deploy based on where we are right now. Silver is something that's been lagged behind. We talked about it for a long time. The gold to silver ratio had been high, which meant that the difference between silver's price and gold's price was at historic highs. And silver's priced very low relative to gold compared to what it normally was. And so that's an opportunity with gold having done what it's done for somebody looking at adding precious metals to say, hey, silver looks really good here in terms of potential move, relatively speaking. We've also seen for the first time in a long time, silver being added to central banks. Russia particularly has added silver buying to their reserve assets. And silver for decades at this point had really fallen out of that monetary role as a reserve currency. So most still don't use it for that purpose. It's primarily an industrial metal used in electronics and solar panels and things like that. But seeing it pick up its pace in the monetary aspect is also quite encouraging.
Philip, I know you remember silver having different spikes through the years, especially back in '79 and 2011. Why does it seem more volatile than gold?
When the economy is strong and there's a lot of demand because of its requirements in electronics and in solar applications and other renewable energy applications. So when the economy is strong, demand for silver in industrial uses is strong. And then in harder times, when the economy goes soft, silver still plays that role of a safe haven and a store of value, but not like gold does. Gold does not have as much of that industrial application. And as a result, gold is much more solid in economic hard times than silver is.
Let's go back to the rate cuts and how it's affected gold and silver. And Jerome Powell acts like there could be more rate cuts, maybe even 2 more before the end of the year. Brad, how's that going to affect both gold and silver between now and 2026?
Yeah, how specifically that plays in is hard to say. Markets are anticipating this, as we've already talked about, right? If you know what is going to happen, things already get priced in with that expectation to some extent. So it remains to be seen how that policy may change based on new data. That's where you may see bigger movements if data comes in very different than what they're expecting, and then they change that rate path. That's where you might see those bigger kind of swings and readjustments, if you will. But going back to what we talked about previously is that we've got to still look at the reason for rate cuts. The reason that they are cutting is due to economic weakness, which eventually leads its way typically through the asset price world. And that's why having a diversified portfolio and safe haven like gold is so important there. But then silver can be used within a portfolio to further diversify. I don't think anybody would make an argument that silver is the core precious metals part of someone's portfolio. When we have stocks, bonds, real estate, precious metals, within that, we want to diversify each of those different areas of assets. And so diversifying within the precious metals, first thing people typically will diversify their gold with is silver to provide that sort of counterbalance so they can work together to make the overall portfolio and precious metals holdings stronger. But we still look at gold as being the core, but silver can be a very, very nice addition that will do well at different times than when gold is doing well.
Brad, let's talk about the future silver demand and the driving forces there.
Yeah, right now, some of the most important things going on in the overall economy, silver's at the center of. If we look at where basically most of the business investment, what we call CapEx spending, is taking place, it's within the artificial intelligence sector. And that's really a driving force currently within markets and the economy. There are billions, if not trillions of dollars going into those sectors. And as one thing you may know about artificial intelligence, it takes a tremendous amount of processing power, chips that can, from companies like NVIDIA and TSMC, Taiwan Semiconductor. And there are the silver is a major component within those. So just the huge growth in that semiconductor industry, that is additional demand, and that's not slowing down. We are at the infant stages of where we're going to be in artificial intelligence down the road, and the amount of artificial intelligence computing power that is going to be created that requires silver. On the flip side of that, artificial intelligence is incredibly power consumptive. In fact, we've seen a meaningful impact just this year with the growth of artificial intelligence on artificial intelligence and energy prices, in fact. And so as prices go up and as this gets built out, the artificial intelligence infrastructure, there are additional demands for power and cheap power. So that's where things like solar come in. And so is kind of driving even more solar demand, which guess what another component within solar panels is? You got it, silver. And the more solar power that gets generated, the cheaper the artificial intelligence is. And you've got this self-reinforcing loop that is really one of the most important trends in the economy right now. And silver is right there in the middle. And we're just literally at the infant stages of that trend.
Philip, it just sounds like silver has a great future ahead of it for people who want to diversify into it.
Well, that's right. And Brad is really making a crucial point about the opportunity that silver presents to ride this wave of AI and the power demand of AI, and the increasing use of solar energy and electronic vehicles. I mean, here in the United States, we've begun to, just this year, cut back on the sales of electric vehicles and also solar panels and other renewable energies. But elsewhere in the world, the demand, of course, the market for silver is a global market and prices are set on a global basis. That demand is going to continue. And the Chinese in particular are moving very rapidly toward a renewable energy society. And as that happens, we're going to see all these sources begin to drive the demand for silver over the next several years. So I think silver is really looking at an outstanding opportunity, riding the wave of forces on the industrial side, and also riding the wave of in the wake of gold prices as they rise over the next several years.
Philip, don't you think that because silver is roughly 1% of the price of gold, that it's very attractive for some people who want to diversify?
Yes, I think it is attractive because of that divergence from the historical relationship with gold. So I think it continues to be attractive. I think gold is going to be aggressive in its in this rally. This rally is far from over. The forces that are driving gold prices are not weakening. Some of them are strengthening. And so I expect that rally to continue. And as silver attempts to reestablish something closer to that ratio with gold, it will likewise be pulled up. The one caution I'd have on the silver side is that if the economy begins to look weak in the United States and in the global economy, and I think the U.S. has really, over the last 5 years or so, has been the heartbeat of the world economy. The U.S. economy has been exceptional in its strength. And I think if we see that fade and the U.S. drift toward or into a recession, then that's going to have global spillover effects. And in that situation, silver, the demand for industrial silver will weaken, and that will slow down silver's price rise, whereas gold will continue to rise. And the thing to remember is that a lot of people are drawn to silver because, it's so much cheaper. You get more for your money. You get more coins, more ounces for your money. But you don't have to buy an ounce of gold. You can buy fractional gold. And those include a number of options, including the products I used to make, the American Eagle. And it comes in 1/10 ounce, 1/4 ounce, 1/2 ounce denominations. So even though there's this huge price difference, that you're able to still afford gold in these smaller units. But that said, I think Brad has really made an important point, and that is that silver is a way, because there's this detachment between the dynamics of gold and silver pricing. That gives you an opportunity to diversify your precious metal portfolio and play the market in different ways, anticipating the market in different ways. One thing, talking about anticipation, I think it's really important especially for new people in investing, to understand that the market is all about anticipation and expectations. And so what we've seen here leading up to this Fed meeting is the hardening of expectations for this 25 basis point cut. to the point where a couple of days ago, the likelihood got up around 95 to 98%. So there's no surprise that when the decision actually came down that it was going to be 25 basis points, that there wasn't a big market move. There could have been a market move if it had been 50 basis points. That would have really surprised the market. If Jerome Powell had said, yes, we've cut interest rates by 25 basis points, but we're really going to be looking at the inflation numbers in the months ahead, and kind of thrown cold water on the prospects for additional interest rate cuts this year, then that would have really been seen as a negative. What Jerome Powell did was just basically meet market expectations, and we saw gold in the day, fairly close to where it was when it began the day. So, and I think that's what the Federal Reserve wanted to do. It didn't want to rock the boat on the market. It is going to be looking very closely at the labor market. If they see weakness in the labor market, they're going to lean toward more cuts. And if they see rising inflation, then that's going to restrain them to some degree, or at least make their decision more difficult to continue with their interest rate cut strategy here.
And watching what rates at the long end, at least specifically at the 10-year, do for the next few months into the end of the year will be interesting. And we certainly don't want to see a repeat of the fourth quarter of last year that led into a lot of downside in markets during the first quarter of this year.
And the thing to remember here is that there's this give and take between the Fed and bond markets. And managing expectations, the Fed managing expectations of the bond markets is a crucial part of that interplay. But by the same token, the Fed has to read the bond market and what their expectations, and understand how their expectations, not only of the Fed's action, but of the much larger economy, the Fed has to read those expectations and include that in their calculations. And what we have today, of course, is enormous pressure coming from the administration for the Fed to lower interest rates. And the Fed has to recognize that pressure, but also recognize that the real driver right now of their strategy of interest rate reductions depends on the market's expectation and on how everybody reads the economic data as it comes in on a weekly and monthly basis.
Well, it sure sounds like there's going to be a lot of anticipation for the fourth quarter of 2025. Philip Diehl, thank you so much. Brad Chastain, thank you as well.
Thank you, Mike.
Thank you, Mike.
We appreciate both of y'all being here. That's all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you for tuning in. If you have any questions or you want to learn more about today's episode, you can call the number in our episode description and speak with one of our friendly account executives. They will be more than happy to answer any questions you may have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. I'm Mike Barnes. We will see you next time on America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.